Good afternoon, everyone. I'd like to start by thanking ColCapital for thinking of us and inviting us to be part of this summit. Over the years, ICG has built a relationship with a number of you as we've expanded our reach into the region, and we're happy to be able to participate in a forum with you all. My name is Michael Sproul, and along with my colleague Brian Spenner, we will be providing an introduction to private credit. We're going to speak on a number of relevant topics, including the evolution of the market, as well as its current state. We will touch on how private credit fits within an alternatives portfolio. I think it's also important that we speak to certain attributes that are specific to private credit and how those attributes have changed over time. And we will also discuss how to differentiate between private credit strategies and managers, which I think is important for everybody here. I'd like to start with a brief overview on ICG and why it is exactly that we're sitting here today. It's brief. ICG has been in existence for over 30 years, and at its core has always had a focus on private credit. We are a public company listed on the London Stock Exchange. We currently have over 50 billion of AUM, of which more than half is private credit. And when I say private credit, I'm including an array of options such as direct lending, mezzanine, real estate, structured credit, and securitizations. And significantly, I think for today, over the last 30 years, we have built a significant private credit business, not only across the US, but Europe, Asia, and Australia. As for introducing ourselves, I've been working in the private credit space for over 15 years. After a stint in investment banking, I moved to the Blackstone Group and worked with Brian on the private debt team for many years. In 2012, ICG asked us to build out their North American private debt platform. And we have been at it for nearly a decade now and have been able to build a multi-billion-dollar platform. With that, I'd like to introduce Brian Spenner, who's going to give us a short overview on himself and then take us into the evolution of the private credit market.
Thanks, Michael. And good afternoon, everyone. And very happy to join you and give you an overview of the private credit market. For me, it's kind of fun to do these types of talks, as it gives me a chance to look back on how far the private credit market has come in the last 25 years. So a little bit from my background. At this point, I'm probably one of the old men in the private credit business. I started doing private credit way back in 1994. Really, my first job out of school was in private credit. And as I look back at that time, we battled to explain to investors why private credit had a role in an alternatives portfolio. At the time, most alternatives were venture and private equity. And we worked very hard to explain to people why private credit was an important component of a well-rounded alternative strategy. So I began my career at Nomura Securities. I spent a decade as a managing director at Blackstone, also spent time at SAC Capital in their private credit team, and have spent the last 8 years at ICG heading up ICG's North American private debt platform. As Michael said, that's grown into a very significant platform for the firm. But I think what's very important as we get into the overview is for you to think about why is private credit important to a portfolio, and why has it become a very large market. And as we think about the market today, it's probably pushing $1 trillion in private credit. And what is the reason that there has been so much demand for private credit from investors? First, it is a terrific asset class that over the last 15 years has really proven its resiliency. It is a market that has many attributes, really sits between private equity and your traditional fixed income, where you have the downside protection in your assets, you have contractual return, you have capital that's junior to you. So in a downside scenario, you're very well protected. But it also offers an investor the opportunity to pick places in the market where they want to invest, design and find strategies that fit their risk tolerances, and really diversify their portfolios. So one of the first questions as we're putting this together that we wanted to answer is what is private credit? And that's very hard to answer because there are so many different strategies that can apply to private credit, whether that be And you may be familiar with these: direct lending, senior debt, mezzanine debt. But also in private credit, there's asset-backed strategies, there's revolvers, there's unitranche, there's real estate, there's infrastructure debt. It's almost limitless. And within each of those categories, you can find other funds with very distinct strategies. So through private credit, you can build a very interesting fixed income portfolio with returns that far exceed what you can get in the capital markets. But as we look at private credit, one of the most important things is, how is it proven out? I'll say over my career, I've been at this now over 25 years. We look back at our track record that we've built over a 25-year period. And if you build a private credit portfolio right, you get some very attractive returns. Our track record, if we consolidate it, is 15% gross return over 25 years, which we put up against any strategy, because not only did we deliver a 15% return, but we did that with very low volatility. And that's really why I think an investor gets into private credit, is the opportunity to invest in an asset class, deliver consistent returns without the volatility, and be confident that no matter what happens in the markets, they have a portfolio that's going to continue to deliver returns. And Michael, if you can put up the slide, something interesting that come across over the years was analysis that a consultant, Cliffwater, did of the performance of different asset classes through the financial crisis. And on this table that Michael's putting on the screen, you'll see at the third one down is Cliffwater's, their direct lending index, showing that at the depths of the financial crisis, their portfolio of direct lending investments was down single digits. And just as important, because that portfolio was throwing off current income, it rebounded very quickly. And it was fully recovered back to positive territory within a year. And you for drawdowns. And that's one of the terrific things about private credit, is the investments are constantly throwing off income, which mitigates any downturn in the overall markets. And as we look at why are investors today very interested in private credit, first and foremost, it's that downside protection. Just another indication of how robust private credit can be if it's done in the right way. As we look at ICG, and as Michael said, the firm's been doing private credit for the last portfolio companies in the last 30 years that had defaulted. So think of that as the portfolio of the worst investments ICG made over the last 30 years. And luckily, there are not many of them, but we have had at times different challenges. But if you take all of those defaulted credits, it's still a positive IRR. And to us, that's reflective of what we think is the terrific credit skills that our firm has. But if you think about private credit, that risk profile, you put together a portfolio of all your mistakes and you still made money. And that's what I think investors are looking to get out of a private credit investment. So one of the other topics we wanted to tackle is not only why do investors want to invest. It's fairly obvious given the returns that you can generate and the borrowers. Today, the market, as I said, is about $1 trillion, and it's probably half in North America, a third in Europe, and it's growing quickly in both Asia, Australia, and other parts of the world. But why has that market grown so much? It's really, and I'll speak from the US where I spend most of my time, it's replacing banks. If you go back to the early to mid 90s, banks were the institution to borrow money. That's where you went if you needed capital. And that's evolved over the last 25 years. Banks in the US, because of regulations, because of profit margins, they're not really in the business anymore of lending money. What they're in the business of is syndicating loans to other people and collecting fees. And that's they figured out. If they do the underwriting, they can earn some fees. The loan's issued, if they can trade it, they earn some more fees. Even if it goes badly, they can earn some more fees. But what they're not doing is putting their capital at risk for the long term. So with that dynamic, it opened up an opportunity for private credit investors to lend money to companies securities or weren't large enough to issue traded securities. So it's become a huge market. If you look in the US, the middle market is really unable to access the capital markets in the United States. The capital markets aren't really excited about lending them capital. So where do they go? They go to the private debt market. And that's why it's become such a large space, is it's really the driver in the US behind the middle market. And we're increasingly seeing that in Europe as well, where the banks are retreating and the private lenders are stepping in. And it's simply logical that a private lender can cut out the middleman effectively. It's connecting an investor directly to a company that needs capital, that all of the returns from that investment make it back to the investor. The banks aren't skimming any fees. So that's really driven this rise of private credit. So you take the combination of investors who've had a terrific experience in private credit, the funds have performed well, and you combine that with companies and borrow capital. And that's why you've seen over the past decade a tremendous growth in the private credit space. And it's really become a core part of alternative portfolios, quickly catching up to where private equity is in many portfolios. And it's really dollars shifting from both private equity as well as fixed income into a market that's offering better returns and more consistent returns. Michael, you want to talk about some of the attributes as we see in particularly the corporate private credit space and why we think it's particularly attractive if done right for investors?
Sure. One thing that I think, as over my career, that the last 15 years, what's evolved is your ability to underwrite is far better in the private debt space. When we think about being a buyer of syndicated loans versus being an issuer of private debt, and let me bring up a chart. There's really a premium for being able to underwrite a private debt deal. It's a closer relationship. The sponsor wants to know who's in their credit. You have the ability to perform primary diligence. You often get board observation rights, which we get. If you don't, you get enhanced reporting. You get enhanced reporting of financials. One thing that's really important in the private debt space is how you document and structure transactions. And by being that close to the sponsor, to the company, you really do get enhanced lender protections when you're negotiating these documents and when you're really partnering with all entities involved, the company, other lenders, and the equity owners. And so it's very different from the syndicated loan world, where essentially in the syndicated market, a bank feeds you a document, you say, okay, you sign it, and you're buying a loan off of the desk. And here, what's important is you're getting added protections. You're getting added protections to your document. You're getting added rights to have a dialogue with the company and the sponsors on a continuous basis. And you're benefiting from a deeper diligence dive, which better prepares you for both the good and the bad that might come from that.
Yeah, and just to reiterate some of what Michael said and why I've spent my entire career in private credit and why I find it so compelling is when you compare it to the capital markets and syndicated loans. In that world, somebody's doing enough due diligence to make sure they can sell the loan. They're making a document that's saleable. That's all the bank really cares about. That's distributing that product is saleable. I don't, at the end of the day, care if it's a good investment. They would like it to be, but it's not the primary driver. The primary driver is it's saleable. In our world, it's very different. In private credit, you're owning an investment. So when we talk to our colleagues in syndicated credit, they may be excited that they had a phone call with the management team before making an investment. That may be a terrific diligence opportunity for them. They're used to reading a book. As I think about private credit, and what really differentiates the good managers in private credit is they get a book that's just the starting point. We don't make an investment without having met a management team. That's been, but I'd never closed a deal without going out to dinner with the management team and making sure there are people that I trusted. It's a completely different level of knowledge. So one of the big benefits in private credit is you are offering solutions. So you're generating versus comparable fixed income risk, 200 to 300 basis points of incremental return. But that's not really where the story ends, because that's how the deal starts, is with that incremental setup yield. But if you do things right, you do your diligence well, you document the deal to protect yourself, and you really manage your portfolio. You don't just monitor it, but you manage it. You work with the company about the investment. You're actually going to have better outcomes. So although you're starting with a nice return differential, you also should have a lower default rate, a higher recovery rate. And when you look back on a portfolio, you're going to have a much higher yield than you would see in the fixed income markets. As I said, my career has been a lot in mezzanine. We've delivered 15% over 25 years. That trounces easily the high yield market. That stands up pretty well to the equity markets. And we did that through debt securities, because you apply that discipline and really work to understand what you're investing in and be a knowledgeable buyer.
Now, to the flip side, Brian, I will say that, private debt lacks liquidity, right? So for the investors that, are looking to trade in and out of debt, so you are getting a premium also for doing that, for managing the portfolio through and over time.
Absolutely. And for an investor that can absorb the liquidity, the premium's great. But we often, when we're fundraising, we meet with investors and they say, how often do you trade this? We say, if you're looking for somebody who's going to trade loans, you should invest in a different fund. That's not a private credit strategy. That's a capital market strategy. We do our diligence and then we manage them very quickly. So the last question we were asked to address, which is not an easy one, is how do you differentiate between managers and strategies in the private credit space? And it's really complex. It's not as easy as differentiating between private equity managers, because there are so many different strategies in private credit. And even within those strategies, there's so many different flavors. Maybe senior direct lending, but is it a levered fund? Is it an unlevered fund? That can have the risk and the return. So what I would tell somebody thinking about investing in private credit is you need to first and foremost decide what your goals are. What returns are you looking for, and what risk are you willing to take to earn those returns? Then you need to sit with a lot of funds and understand the strategies and the structures to differentiate. Because even within, if we do direct lending in the US, are you investing in large companies, small companies, private equity-backed companies, founder-owned companies? Those all have implications for risk and return. So you have to spend a lot of time about private credit managers is, what is their track record? Within private credit, the dispersion of returns across funds is very low in the good times, because everybody's getting their interest. You don't really see who is good at the private credit business until you have a dislocation and a downturn. And then you see who did a good job picking the right names. So as I think about the assessment of managers, it comes first and foremost, who has done this for a long time, knows the pitfalls, and knows how to manage a portfolio. And then lastly, we won't go back, but the slide on the difference between syndicated loans and private debt. You really want a manager who understands that difference, and they're directly originating their loans. They're not buying them from banks. They're doing primary diligence. They're taking advantage of that opportunity. They're documenting their deals to manage risk. They're managing their portfolio, and they have experience in workouts. If you can check all of those boxes, you're going to find a manager that has a wealth of experience and is going to deliver strong returns regardless of the market environment, whether that be a robust credit environment, a recession. Private credit done right should deliver returns consistently year in and year out. And as I started, That's why private credit has grown to $1 trillion+ market versus both fixed income and differentiated risk versus private equity. Anything you want to add, Michael?
No, you know, in my experience, this has proven to be a resilient asset class in every interest rate environment, in every economic environment. One just has to be careful with picking, to your point, you know, a manager that's gone through an economic crisis, a manager that's done this for a while. You know, I think managers that, you know, have a bit of an easy road over the last, you know, 8 or 9 years, taking away COVID. But, you know, I think it's important for investors to think about somebody who knows their way. We always get asked, have you done a workout? You know, and it's not telling that you did a bad job taking an investment, but it's telling that you know how to manage a private portfolio. And it's important for people to be able to do that as you think about, you know, picking your managers. But it has proven to be a resilient market. It is one that is, you know, has strong yields. And I think it's one that, as it's a testament to being over $1 trillion, is going to be around for a while. With that, Brian, do you have anything else to add?
No, I'd just like to thank everyone for taking the time. And, you know, as I said, our firm has a wealth of experience in private credit, and to the extent we can ever be a resource for anyone on this video conference, please feel free to reach out. We're always happy to discuss the markets and our views of the markets, where they're headed.